Hi, in this video we'll introduce the put options. So we've dealt with the call options, which give the investor the right to purchase the underlying asset at the strike price at maturity. The put options will give the investors the right to sell the underlying asset at the strike price at maturity. And similarly, we'll be dealing with the underlying asset of a non-dividend paying stock, and we'll be dealing with a European type of option. So you can only exercise it at maturity, and you cannot exercise it earlier than maturity. So what would be the payoffs for a long position for a put option in this case? So as an investor for a single unit of a put option, you will only exercise it when the strike price is higher than the spot price of your underlying asset, because now you can sell the underlying asset above the market price or above the spot price, and hence you will make a profit. Okay, so we can write it in a mathematical way, which is the maximum between 0 and k minus st, which is the opposite for this part compared to the call option. Okay, and you will never exercise it if the spot price of your underlying asset st is higher than your strike price, because you will now be selling below the market price, and hence you'll make a loss in this case. So we can express this on a diagram as well. So you will only exercise it if your st in this case is lower than k. So for any st that is higher than the strike price, you will never exercise them, so your payoff will be naturally 0. And for an investor that's holding just 1 unit of the put option, you will always have 45-degree line, but in this case it will be over here. Okay, and this will be the payoff for a long position for a put option in this case. So what about the short position for a put option? So if you sell the option to someone else, then your payoff will be again rotated around the x-axis, or the mirror image of the payoffs, but around the x-axis. So here will be 0 as well, but then at this part it will be negative. And also this will be a 45-degree line and a 45-degree line over here as well, because we're only investing, and we're assuming that we're only investing in 1 unit of the put option. Okay, but remember, we're only talking about the intrinsic payoffs for the call options and the put options as well. So these are financial instruments, or these are actual derivatives. They will never come at a free price, because they'll provide you with some options or some right to purchase something else, right? So they do possess a bit of value, and whenever they have value, you must put a price on it. The actual or the detailed pricing on the options we'll discuss it later, but know that these things don't come free. Okay, so if we consider the actual prices of the options, then our payoff or our net payoffs will be just a little bit different, because now we'll have to consider the cost of buying the options or the profit for selling the options. Okay, so we'll combine the payoffs together, and we'll also consider the net payoffs in this case. So with the net payoffs, we consider the costs, right? So net of the costs. So for example, if we are buying a call option or a long position in the call option, then we have to pay its price in the first place. So rather than having something that's starting from 0 or here, we would have to pay something at a price. So we need to shift the whole payoff downwards just by a little bit. Okay, so we would have to shift it downwards and then go up in terms of the payoff. Okay, so we would not actually make a profit until some point over here. So even it's slightly above the strike price, in this case, if we're going long in a call option, we'll still make a tiny loss, because we have to cover the call option, the price of the call option itself. So it must be somewhere above the cost itself that we're actually making an actual profit in this case. Okay, but how much would be this cost? We'll discuss it later, and we'll put a price on it using different methods. Okay, so this is the actual net payoff for a long position in a call option. So this will be a long call. Okay, and then what will be our payoff if we're in a short position for a call? And naturally, you just have to flip it over the x-axis in this case, or the horizontal axis in this case. That will be here. Okay, this will be our net payoff if we're going to short a call. As you can see, if our counterpart, which is the other investor that is buying our call option, if they never exercise their call option, then we're just going to make a profit, and that profit will be the price of the option itself. So we're basically betting against the other party that they will never exercise it, and the profit that we make for a short position is going to be the price of that a call option. Okay, so similarly, we can do a net payoff for our put options as well. So if we're going to go long in a put option, then our payoff will be shifted slightly downwards a little bit. Okay, so suppose this is K as well, but then we'll be paying a bit of cost before we can make actual profit over here. Okay, so this will be our long position for a put option, and its net payoff. And similarly, if we have a short position for a put option in this case, then we'll just have to flip it, but then we'll make a profit if our counterpart does not exercise it. And if they do exercise it, and if the strike price is really high, then we will make a loss because we will now have to fulfill the other party's option. Okay, so this will be a short put, the payoff or net payoff for the short position for the put option in this case. Okay, so this will be net payoffs. So be careful when you're trying to draw the actual graphs. Most likely, we're going to draw the net payoffs because we'll always need to consider the actual prices for these options, and this will be very important as well. Okay, so for now, it will be good for you to memorize these 4 different graphs and try to understand the inner workings of these options, which is why do we need to exercise, when do we need to exercise, and why are we making a loss, and why are we making a profit. Okay, and I'll see you in the next video.